In the ruthless world of finance, one breed of investors has endured the test of time. Through discipline and rationality, they make profits when others lose, finding value where no one dares to look. But among them all, one man stands apart. They call him the $150 billion vulture. He isn't the loudest voice on Wall Street. He doesn't chase headlines or hype or applause. Yet when the markets lose their mind, he's the one everyone listens to. While others see prices, he sees behavior. Where the world reacts in fear, he reads emotion, turning panic into opportunity and uncertainty into profit. From a quiet desk in Los Angeles, he built an empire on caution, one memo at a time. Each word dissecting the madness of the crowd, each insight guiding trillions in global capital. They call him the vulture of Wall Street. When the world drowned in greed, he stood still. When the world froze in fear, he bought it. He turned doubt into discipline and discipline into Oaktree, a $200 billion fortress of reason in an irrational world. This is not the story of a gambler, it's the story of a thinker, a man who proved that patience can outperform genius and psychology can outlive prediction. This is the story of Howard Marks, the philosopher of modern finance, the vulture who taught Wall Street how to think twice. Born in 1946 in Queens, New York, Howard Marks grew up in a modest Jewish home in Rego Park, a middle-class neighborhood. His father, an accountant, taught him that every number tells a story. His mother's long illness taught him that uncertainty is life's constant, and when near-fatal sickness forced her to stay home, she turned to Christian Science. Her recovery deepened her faith. For young Howard, it sparked skepticism. At school, he was far from brilliant. Teachers called him an underachiever, a label his mother repeated after every parent-teacher meeting. At the Wharton School, he majored in accounting, but soon discovered something livelier. Finance. Accounting records the past, he said later. Finance imagines the future. He also minored in Japanese philosophy and met the concept of mujo impermanence. Graduating in 1967, he moved on to the University of Chicago Booth School of Business, earning his MBA in 1969. Chicago preached the efficient market gospel, but Marks was unconvinced. That same year, he joined Citicorp, stepping onto Wall Street just as a new financial age was beginning. The late 1960s and 1970s brought inflation, oil shocks, and shattered certainties. Under legendary CEO Walter Wriston, Citibank pioneered certificates of deposit, credit cards, and ATMs, and even held the first-ever analysts' dinner in 1972. As a young equity researcher, Marks excelled until success turned painful. His department pushed the so-called Nifty 50 blue-chip giants like IBM, Xerox, Kodak, Polaroid, and Eli Lilly companies, thought invincible. When that bubble burst, the portfolio lost nearly 90% of its value. In 1978, Citicorp reassigned him to the bond department, a move some called a demotion. But that would define his life. Soon the phone rang. There's a guy in California named Milken. He deals in something called high-yield bonds. Figure it out. What others dismissed as junk, Marks saw as mispriced risk. He also saw how even bankrupt companies could reward buyers of their CCC-rated debt. If they died, assets could be sold. If they survived, debt could convert to equity. Heads, you win a lot. Tails, you don't lose much. The logic turned Wall Street's fear into his playground. By the early 1980s, his disciplined handling of convertibles and high-yield securities earned consistent gains while others chased speculation. He even relocated to California to be near Milken, the epicenter of the high-yield revolution. Then, in 1985, opportunity knocked again. He joined the TCW Group in Los Angeles, a fast-growing asset management firm eager to build a high-yield platform. Marks hired him, and together they launched a $100 million distressed debt fund inside TCW. From 1985 to 1987-1994, the pair delivered extraordinary results, proving that calm reasoning could thrive amid chaos. They were unemotional, methodical, fearless, the quiet vultures who found order in disorder. By 1995, after years of success at TCW Group, Howard Marks and Bruce Karsh reached a breaking point. They had built TCW's high-yield and distressed debt empire from scratch, but their philosophy no longer fit within corporate walls. Investing to them wasn't about speed or speculation, it was about discipline, risk control, and patience. So when internal politics clashed with principle, they walked away. In Los Angeles, they founded Oaktree Capital Management, a firm born from conviction rather than ambition. But leaving TCW wasn't without drama. At first, TCW founder Mark Stern refused to back them, viewing their departure as betrayal. Yet after TCW suffered heavy mortgage bond losses and risked losing clients to the duo, Stern relented. He invested $2.5 billion of seed capital into the newborn Oaktree Fund, a deal that turned a rivalry into reluctant partnership and became Oaktree's first victory before it even opened its doors. Investors everywhere were doubling down on startups with no profits, sometimes no products. Marks refused to follow. He believed the world's collective greed would eventually turn to fear, and when that happened, Oaktree would be ready. When the dot-com bubble burst in 2000, that patience paid off. As the Nasdaq collapsed, they quietly began buying the debts of companies others called hopeless.
The Nasdaq took 31 months, who's counting, to plunge 78% after the internet bubble burst in 2000. Climbing out of that hole took 13 years of your life.
Distressed debt opportunities appeared everywhere: tech firms, telecom giants, and over-leveraged media companies. By 2002, Oaktree's assets under management had surged past $25 billion. Among their boldest plays was Regal Cinemas. In 1999, the theater chain was drowning in debt and facing bankruptcy. Then came the next proving ground. In the mid-2000s, easy money flooded global markets. Real estate prices soared, credit standards dissolved, and banks wrote loans faster than they could count them. By 2008, the inevitable happened. The US housing market imploded, taking the global financial system with it. Banks collapsed, liquidity vanished, and fear became the world's dominant currency. For most investors, it was paralysis. For Oaktree, it was preparation meeting reality. They had already raised one of the largest distressed debt funds in history, $11 billion, sitting on the shelf waiting for this moment.
Well, in 2007-8, our funds had always been $1 billion or $2 billion. We thought there was something coming, and we raised $11 billion for what we thought would be a crisis, which did materialize.
Then Lehman Brothers fell. CEO Dick Fuld expected a bailout from Treasury Secretary Hank Paulson, but it never came. Within days, AIG teetered on collapse. The system had stopped, Marks later said. Just days after Lehman's bankruptcy, he wrote a memo that became legend. Either the world is ending or it isn't. If it ends, nothing matters. If it doesn't and we fail to buy, we've failed our clients. Oaktree deployed $600 million a week, buying what others dumped. When the dust cleared, those bets delivered $6 billion in gains. By 2011, Oaktree had compounded a 19% annualized return. From the wreckage of the financial crisis, Oaktree rose as the ultimate survivor, a firm built not on risk, but on mastering fear. By 2010, the smoke of the financial crisis had cleared and Oaktree stood taller than ever. Its disciplined 2008 bets had turned billions in distressed debt into profit, proving that rationality could survive panic. For Howard Marks, it wasn't about money. It was proof that psychology, not prediction, was the real edge. His memos, once private letters, now circulated across Wall Street and Silicon Valley. With titles like Dare to be Great and On the Line, they dissected human behavior as much as markets. In 2012, Oaktree went public on the NYSE Under the ticker OAK, the IPO, priced at $43 per share, symbolized Marx's restraint and humility in a market obsessed with hype. While rivals like Blackstone and Apollo chased buyouts, Oaktree stayed true to its core: credit, distress, and discipline. Through the mid-2000s, Marx doubled down on education. His book, The Most Important Thing, distilled decades of experience into one timeless idea: you can't predict, but you can prepare. In 2018, the SEC fined Oaktree for a minor pay-to-play rule breach, a rare blemish on its spotless record. Marx responded by tightening compliance and reminding his team, "Reputation is built one decision at a time and can vanish in one." That same year, he released Mastering the Market Cycle, a decade after sequel to his crisis triumph. Between 2010 and 2018, Howard Marks evolved from investor to philosopher, mastering not markets, but human emotion. The year 2018 tested Oaktree in an unexpected way. After decades of spotless conduct, the U.S. Securities and Exchange Commission charged the firm under its pay-to-play rules penalty. The fine was small, yet for a company built on caution, it felt seismic. For Howard Marks, integrity was another form of risk control. By 2019, a far larger change arrived. Canadian giant Brookfield Asset Management purchased 62% of Oaktree for nearly $5 billion finances.
Oaktree selling 62% of itself to Brookfield Asset Management.
To outsiders, it looked like a takeover. Inside, it was a merger of philosophies: Brookfield's scale with Oaktree's restraint. Marks and Bruce Karsh stayed in charge of daily management, ensuring the firm's soul remained intact. Together, they built one of the world's largest alternative investment platforms. From 2020 to 2022, while the world swung through pandemic panic and stimulus euphoria, Oaktree's caution became its weapon. He warned that free money would breed fragility, that discipline would again be rewarded. By 2023, assets under management had surged past $200 billion finances. Oaktree was now Brookfield's autonomous credit engine, serving sovereign funds and pensions that prized one thing above all: stability. Then came 2024, a year that put Oaktree back in headlines for reasons beyond finance. Through a loan-to-own structure, the firm seized control of Inter Milan, one of Europe's oldest football clubs, after its owners defaulted sales. To critics, it looked ruthless. To Marks, it was contractual discipline. That same year, Oaktree closed its Distressed Opportunities Fund 12, a record $16 billion vehicle, the largest in its history, finances sales. By 2025, the numbers told the story. More than $209 billion under management. Half of it is anchored in credit and private debt strategies. Revenue stable, investor confidence unshaken. Marks now served as co-chairman, guiding philosophy while Karsh ran execution, history. Across this decade of expansion and uncertainty, one truth endured. Oaktree never won by predicting the cycle, it won by surviving it. And in an era of AI-driven trades and speculative frenzy, Marx's words carried a weight few could ignore. Risk is what's left over after you think you've thought of everything. In the end, this isn't the tale of a gambler who got lucky. It's the journey of a thinker who chose patience over glory, preparation over prediction, and discipline over noise. From early life lessons in uncertainty to the hard truths learned at Citicorp, to the empire forged at TCW Group and crowned with Oaktree, the through line never changed: control the risk, and the reward will follow. In booms, he stood still. In busts, he moved first. And somewhere between fear and greed, he built a fortress of reason, brick by careful brick. Because markets don't remember our predictions, they remember our decisions. This was the story of Howard Marks, a philosopher of modern finance, a keeper of discipline, and a reminder that in every cycle, the loudest advantage isn't certainty, it's clarity.